Okay, now we're going to talk about free market portfolio theory. This is part 2, and we're going to look at the academic approach. Who are the folks that are involved in giving us this approach? Market portfolio theory is an investment approach that's based on 50 years of research and sound economic principles. It's also a disciplined approach that seeks to capture market return and not chase it, which is what most people do. So we're going to look at 3 components of this theory: free markets work, modern portfolio theory, and the three-factor model. So leading academics, these fellows, Harry Markowitz, Merton Miller, won the Nobel Prizes in 1990 for a lot of their research. Harry Markowitz did his research as a graduate student in the 50s. And because of computing power, we were then able to prove this research. Rex Sinkfield and Roger Ibbotson, you've probably heard of Ibbotson before, but these are all bigs in financial economics or in research. And then Eugene Fama and Kenneth French. Eugene Fama won the Nobel Prize in November of 2013 on his research of efficient markets. So the basis of efficient markets is that free markets work. It's the market at any point, or a stock at any point, or your car or your house at any point. The actual price of that item is based on all knowable information at the time. If you think about it in terms of your house, you could have sold your house for a lot more in 2006 than you could in 2008. The market determined what that price was typically. It's the same thing in stocks. So if it's possible to beat the market, like the financial media would have you think, then the market must price goods and services inefficiently. It would be possible for somebody to identify those inefficiencies in advance and then predict the price, or say that the price was inaccurate and plan for that. Things would be underpriced or overvalued in a market. If they were, they could be forecasted. Then we could aim to build our portfolios to capture that. Or managers would want to take advantage of mispricings. People would and this is what people do, actually. They chase returns because they think they're hearing these stories that you can beat the market. But if the market is random, which is what the financial economics research shows, then why don't I just capture all these returns? So it's a different philosophy, the philosophy between an active investor and a more passive approach. The free market is the best determinant of market prices based on supply and demand. All available information is factored into the price of the stock. Only new and unknowable information would cause these pricings to change. And I don't know about you, but I don't know anybody who knows unknowable information. And if they do, and they're doing insider trading, we know that's not right. The randomness of the market makes it impossible for an individual or entity to consistently predict the market. So instead of trying to chase these returns, why don't I just try to capture the returns that I know are there based on the data? So component 2, modern portfolio theory, diversification works. So that's Harry Markowitz, William Sharpe, and Merton Miller. So here's Harry Markowitz again, and his biggest contribution was on portfolio design and risk reduction, which is very important. Why would you take risks for which you are not compensated? How can we plan for that? And what he did was develop this, all his information was in developing a graph that demonstrates all portfolios are going to fall below an efficient frontier. So if you look down here to the right where the S&P 5 window is, the S&P 5's long-term rate of return is between 10 and 11%, but the volatility, or the roller coaster that you're on, is pretty significant. It's between 18 and 20%. Well, if I can get the same return for a significantly less volatility, that might work for me in the long run, especially when I go to take income. So another study that was done demonstrates these facts, that market timing, factors such as news, stock selection, are all very small parts of a portfolio's performance. In fact, almost 92% of a portfolio is based on its allocation. So that's more of a predictable factor in terms of portfolio design and what I'm looking to accomplish. When I look at asset classes, large, small, international, US, and I want to know how these different asset classes work, what I know from the research is that they tend to move opposite each other, or they tend to have different pricing that occurs. So if I own more of them, I can offset the volatility of any one asset class by owning these 2 or 3 or 4 or 5 different asset classes. And that's what correlation is. We want to have things that are negatively or uncorrelated in our portfolios. So the potential to increase returns and reduce volatility is pretty significant if I use the research and I start including different asset classes between US large, international large, or international small. Now, component 3 is the 3-factor model, and this was Eugene Fama's research that proved this. So you have a market factor. Well, we all know equities are more risky than bonds. And so therefore, they should provide more of a return, which they do. The trouble for most investors, if you remember back to the Dahlbaugh research, is that the average equity investor's return is basically 3.5. So what this is happening here is you're getting a market risk at the S&P level, and you're getting a bond return for most people. But the market factor, we know over time, is we're going to need that to offset inflation and other things. The size factor. So small companies do tend to outperform large companies. They are riskier, so they have a larger roller coaster ride. But when you put them together, you can decrease that volatility in your portfolio. Then factor 3 is the value factor. The high book to market, or just stocks that may be slightly distressed, will tend to pay more or have a higher return than stocks that are not distressed. And so over time, that's a pretty significant return. And we want to put that into the portfolio to get that return and offset the volatility. So the academic scientific approach to all of this is that free markets do work. And if you combine them with modern portfolio theory and a 3-factor model, by structuring your portfolio properly, you're going to have a successful long-term investing experience. Especially important when you get into retirement and it changes the game for income withdrawal. Now, in the third part of this video, we're going to be looking at portfolio design based on the academic research.